Remember when you could get a Big Mac combo for under $5? In 2025, the same meal will cost you $12. But is it just inflation or is it something deeper going on? In this episode, we unpack the economic storm behind America's fast food crisis, rising wages, supply chain shocks, and shifting consumer expectations. Using classic economic theory, we'll show you why your drive-through is starting to feel like fine dining and what it says about the future of affordable food. Across the US, customers are posting viral receipts. $17 for a basic meal at McDonald's or Wendy's. But this isn't just price gouging, it's a symptom of a broader economic forces reshaping how we eat and spend. In this episode, we'll explore how the fast food industry has become a microcosm of economic stress, from cost push inflation to labor policy to shifting consumer expectations. Cost push inflation happens when the cost of production inputs like wages, rent, utilities, and raw materials rises, causing businesses to increase prices to reflect on the final price. Unlike demand pull inflation, which is driven by consumers spending more, cost push inflation originates from the supply side. In this fast food sector, labor is often 25 to 30% of the operating costs. When states mandate minimum wages increase, that input cost spikes overnight. This means that for chains like McDonald's and Wendy's, operating in high wage states like California or New York, prices must rise just to maintain profitability. This chain reaction is exactly what cost push inflation predicts, and we are seeing it play out in real time. Today, many fast food workers earn between $15 to $20 an hour, significantly more than a decade ago. This is a major victory for worker advocacy and minimum wage policy. However, it also increases operating expenses dramatically. When companies raise wages, they often face three choices: reduce headcount, raise prices, or automate. Most choose to pass the costs to consumers, which contributes to what economists call the wage price spiral. As workers earn more, prices rise to match, and then worker demands higher wages again to keep it up. It's a self-reinforcing loop, especially visible in labor-intense service industries like the case of fast food. In the past, fast food was considered relatively price inelastic. This means that people kept buying regardless of small price changes. But elasticity isn't fixed. As prices rise beyond the psychological threshold, say $15 a combo meal, consumers begin altering their behavior. More Americans are now buying groceries, meal prepping, or turning to alternatives like convenience stores or food trucks. Elasticity increases when substitutes are readily available, and the fast food industry is starting to see that substitution effect in real time. When pricing starts to resemble casual dining, the value proposition erodes and loyalty breaks down. Shrinkflation is when a portion size decreases while prices remain the same or even increase. It is a way to mask inflation without triggering price shock. Many fast food chains now serve smaller patties, thinner fries, or half-full cups while keeping price tags high. On the top of this, menu engineering uses psychological pricing, bundle tricks, and visual placement to steer customers toward more profitable combos. Think about limited time offers, oddly priced sides, or medium drinks costing only 20 cents less than the large. These techniques maximize margins in a tight economy, but also risk damaging trust if customers feel deceived. It is also important to note that most fast food outlets are franchises. This means that they are not owned directly by the corporation. So local operators pay franchise fees and follow corporate rules, but must cover rising costs themselves. As wages, rent, and food prices rise, many franchisees are finding their margins evaporating. In some cases, corporate pricing decisions don't align with local realities. A McDonald's franchise in San Francisco might be required to sell the same combo meal as one in Boise, but with vastly different cost structures. This mismatch between central policy and local economics is creating serious tension and even driving some franchises out of their business. Global supply chains have faced near constant disruption. For fast foods, this means ingredient shortages, higher shipping costs, and delays. Staples like beef, tomatoes, and cooking oil have all seen prices hikes due to droughts, transport bottlenecks, and labor shortages. In a system optimized for JIT, or just-in-time delivery, even a small disruption leads to huge cost spikes. A delayed lettuce shipment raises the price of every Big Mac served that day. Over time, these small shocks compound into higher menu prices. Supply chain instability is no longer a temporary issue, it is becoming a structural constraint. Also, the internet has become a stage for fast food outrage. Viral TikToks showing $17 receipts, Yelp reviews calling out smaller portions, and angry Reddit threads all point to one thing: consumer expectations have been violated. Fast food has long held a psychological role as an affordable comfort food. When that comfort becomes unaffordable or feels like a poor deal, trust is broken. In marketing, this is called brand equity erosion. Once customers feel tricked, it takes years to rebuild credibility. The backlash we're seeing is not just emotional, it has economic consequences for customer retention and lifetime value. With rising wages and staff shortages, many chains are turning to automation. Self-serve kiosks, AI ordering systems, and even robotic fry cooks are being tested and rolled out across the US. These technologies promise efficiency and lower labor costs. However, automation isn't a perfect fix. Machines break, require training, and can alienate customers, especially older ones who prefer human interaction. There's also the upfront capital costs to consider. In economics, this is a capital labor substitution trade-off, and it doesn't always yield savings on the short run. Plus, if too many jobs are replaced, the broader economy suffers from reduced household income and demand. Food emerged in the post-war era when the US economy was booming, labor was cheap, and mass production reigned. Today, that world is gone. Climate disruption, rising inequality, regulatory pressures, and global competition have all reshaped the fundamentals. What we're witnessing is not just inflation, It's a structural recalibration of what food should cost in a modern economy. The $17 burger isn't a glitch, it's a signal. As we rethink food systems, labor fairness, and value perception, the fast food model might either evolve or fade in something that we won't recognize anymore.